On April 7th, Donald Trump announced a ceasefire with Iran. That announcement revealed two important lessons. First, Truth Social suddenly became the center of global attention. Second, markets hate uncertainty more than almost anything else. The very next day, stocks surged higher. The S&P 500, NASDAQ, and Dow all posted major gains. Within weeks, stocks were back near record highs. Most financial media called it a relief rally. But the real story was far more interesting. To understand what happened, we need to look back. Earlier, geopolitical tensions had shaken global markets. Critical shipping routes faced major disruptions. Investors watched markets suffer heavy losses. Fear quickly spread across Wall Street. Hedge funds began selling at an aggressive pace. Major financial institutions closely tracked the situation. Investor sentiment turned overwhelmingly bearish. Then came the ceasefire announcement. Markets immediately exploded higher. Oil prices dropped sharply. Yet many signs of disruption still remained. So what actually pushed stocks higher? The answer was a powerful short squeeze. A short seller profits when prices fall. But when prices rise, losses can grow rapidly. Eventually, brokers demand more collateral. Traders rush to buy back shares. That buying pressure creates a short squeeze. Then, trading algorithms join the rally. Many systematic funds switched from short to long. Billions of dollars flowed into equities. Options dealers added even more buying pressure. And this pattern has happened before. Today's market operates very differently than it once did. Three powerful forces pushed markets upward. Passive investing now controls a huge share of the market. A small group of giant companies dominates major indexes. Meanwhile, options trading continues to grow. Modern markets often react faster than humans can think. Today's stock market is a giant feedback loop driven by algorithms, passive funds, and options traders. If you enjoy deep market analysis and financial education, subscribe for more videos.